Ladies and gentlemen, because what I am about to discuss is not a routine market development, and it is certainly not something that serious investors can afford to dismiss. What is happening in silver right now deserves far more attention than most people are giving it. The majority sees a breakout, they see price momentum, they see another commodity making headlines, but that is not what concerns me. What concerns me is what the breakout may be telling us about the movement of capital itself. You need to understand something that history has proven again and again. Markets rarely communicates the most important messages through headlines. They communicate through behavior. They communicate through positioning. They communicate through where capital decides to go when uncertainty begins rising beneath the surface. And right now, I believe silver is sending a message that many investors are completely missing. This is not speculation. This is not a prediction based on hope or fear. This is an observation about how financial systems behave when structural pressures begin building simultaneously. The real question is not whether silver can continue moving higher. The real question is why capital appears increasingly willing to move towards silver at this stage of the cycle. That distinction matters because when investors ask the wrong question, they usually arrive at the wrong conclusion. Most people focus on outcomes. Very few focus on causes. I want you to think about the environment we are operating in today. Global debt remains extraordinarily high. Governments continue carrying obligations that would have been considered unimaginable only a generation ago. Corporate balance sheets remain dependent on refinancing. Consumers are facing persistent pressure from elevated living costs. Interest expenses continue rising across multiple sectors of the economy. These are not isolated problems. They are interconnected pressures. And when enough pressures begin building inside a debt-driven system, capital starts behaving differently. This is where most investors make a critical mistake. They assume that financial systems remain stable until a crisis becomes obvious. But that is not how major transitions unfold. Major transitions begin quietly. They begin beneath the surface. They begin when institutions start reassessing risk before the public recognizes what is happening. History has shown that the biggest shifts often occur long before the majority notices them. By the time television commentators are discussing a structural problem, capital has usually been repositioning for months. That is why I pay attention to assets like silver. Silver occupies a unique place within the financial system. It is not purely an industrial commodity. It is not purely a monetary asset. It sits between multiple worlds at the same time. It responds to industrial demand. It responds to inflation expectations. It responds to monetary credibility. It responds to liquidity conditions. And perhaps most importantly, it responds to shifts in investor psychology. When silver begins strengthening while broader macroeconomic conditions remain uncertain, I do not immediately focus on price targets. I focus on interpretation because price is visible. The message behind the price is what matters. Now ask yourself a simple question. Why would sophisticated capital become increasingly interested in hard assets when economic uncertainty remains elevated? The answer is not complicated. Capital seeks durability when confidence begins weakening. It seeks resilience when financial conditions become less predictable. It seeks optionality when systemic risks become more difficult to quantify. This never happens all at once. It happens gradually at first. Then suddenly the majority always underestimates this. The speed at which capital rotation can accelerate once enough. Participants recognize that the environment is changing. You need to understand that modern markets are built on confidence. Confidence in debt, confidence in liquidity, confidence in institutions, confidence in monetary stability. As long as that confidence remains intact, risk-taking flourishes, investors become comfortable, asset prices rise, leverage expands, speculation becomes normalized. But confidence is not permanent, it is conditional, and once confidence begins deteriorating, investor behavior changes rapidly. This never ends quietly. Most people are completely blind to what is forming because they are conditioned to believe that stability is the natural state of financial markets. It is not. Financial history is a sequence of cycles, expansion followed by correction, confidence followed by doubt, leverage followed by deleveraging. Every cycle eventually reaches a point where accumulated imbalances become impossible to ignore. I am not saying that we are facing an immediate collapse. Serious analysis requires more discipline than that. What I am saying is that structural conditions are becoming increasingly important, and silver's behavior may be reflecting that reality. When debt burdens rise, liquidity becomes more important. When liquidity becomes more important, capital becomes more selective. When capital becomes more selective, certain assets begin attracting attention for reasons that extend far beyond short-term price appreciation. That is the environment I believe investors need to examine very carefully, because once capital rotation begins, the process often becomes self-reinforcing. Money flows toward perceived resilience. Those flows attract additional attention. Positioning changes, expectations change, and eventually the broader narrative changes as well. But by then, the most important phase of the transition has already occurred. The real danger is not missing a rally. The real danger is misunderstanding what the rally represents. Because if silver's breakout is reflecting a deeper shift in capital behavior, then the implications extend far beyond one metal. They extend into the broader financial system. They extend into investor confidence. They extend into liquidity conditions, and they extend into the future direction of the cycle itself. That is why I believe this moment deserves serious attention, not excitement, not speculation, attention, because the signals emerging beneath the surface today may ultimately prove far more important than the headlines investors are focused on right now. I want you to understand something that many investors never fully appreciate until they experience it firsthand. Markets are not primarily driven by stories. They are driven by liquidity. Liquidity is the foundation beneath every major asset class. It determines how easily capital moves, how comfortably leverage expands, and how confidently investors take risk. During periods of abundant liquidity, almost everything appears healthier than it actually is. Asset values rise. Financing remains available. Borrowing becomes easier. Investors begin assuming that favorable conditions will continue indefinitely. That assumption becomes dangerous because liquidity has a cycle of its own. And when liquidity begins tightening inside an economy already carrying substantial debt burdens, the consequences spread far beyond any single market. This is where the situation becomes more serious than most people realize. The modern financial system is heavily dependent on leverage. Governments rely on debt issuance. Corporations rely on refinancing. Consumers rely on credit. Financial institutions rely on funding markets functioning smoothly. Everything becomes interconnected. As long as liquidity remains abundant, those connections appear stable. But when liquidity becomes more selective, hidden vulnerabilities begin emerging throughout the system. History has demonstrated this repeatedly. What appears strong during expansion phases often reveals fragility during tightening phases. What appears permanent often proves temporary. What appears stable often depends entirely on conditions that can change much faster than expected. This is why I believe investors should pay close attention to what silver may be communicating right now, because silver does not move in a vacuum. No asset does. Every meaningful move occurs within a broader framework of incentives, expectations, and capital allocation decisions. And when capital begins shifting toward assets associated with monetary protection, investors should ask themselves why. What risks are becoming more visible? What pressures are increasing beneath the surface? What conditions are changing that the broader public has not fully recognized yet? These questions matter because major market transitions rarely begin with panic. They begin with repositioning. Institutional investors do not wait for crisis headlines before adjusting exposure. They evaluate probabilities, they evaluate risk, they evaluate durability, they study liquidity conditions, they study debt, sustainability, they study refinancing pressures. And when those factors begin pointing toward greater uncertainty, capital starts moving accordingly. Most retail investors never see this stage. They are focused on daily price movements. They are focused on short-term narratives. They are focused on whatever explanation dominates the news cycle, but financial systems operate through mechanisms, not headlines. The headlines arrive later. The repositioning happens first. This is why I continue emphasizing that the significance of silver's breakout may not be the breakout itself. The significance may be what the breakout reveals. Because capital rotation is rarely random. Large pools of capital do not suddenly abandon one area of the market and move into another without reason. These decisions reflect changing assessments about risk and opportunity. And when those assessments begin changing simultaneously across multiple institutions, powerful trends can emerge. The challenge is that most people recognize those trends only after they become obvious. By then, the environment has already shifted. Think about every major financial adjustment throughout history. The pattern is remarkably consistent. There is a period of expansion. Confidence grows, credit expands, ox prices rise. Investors become increasingly comfortable, then subtle pressures begin appearing. Debt burdens increase, financing becomes more expensive, liquidity conditions tighten, certain assets begin behaving differently. At first, almost nobody notices. The majority remains focused on the previous cycle. They assume yesterday's conditions will continue tomorrow. That assumption persists until reality forces a reassessment. And when reassessment finally occurs, it often happens very quickly. This is why I believe the concept of capital rotation deserves much more attention than silver's price alone, because capital rotation reflects changing priorities. It reflects changing perceptions of risk. It reflects changing expectations about the future. And once those expectations begin shifting, markets can reprice far faster than most participants anticipate. Now consider the broader backdrop. Inflation remains a concern across many areas of the global economy. Growth is becoming less consistent. Debt servicing costs remain elevated. Central banks face increasingly difficult decisions. If policymakers tighten too aggressively, financial stress increases. If they loosen too aggressively, inflationary pressures can intensify. Neither path is simple. Neither path is without consequences. This creates uncertainty. And uncertainty changes investor behavior. When confidence in easy solutions begins fading, capital starts searching for alternatives, not because investors are emotional, because they are rational. They are responding to incentives. They are responding to probabilities. They are responding to structural realities. This is why I often say that the most important developments in markets occur before they become obvious. The crowd waits for certainty. Serious investors study signals. The crowd waits for confirmation. Serious investors study behavior. The crowd reacts to narratives. Serious investors focus on structure. That difference in approach can determine whether an investor remains prepared or becomes trapped. Because once structural pressures intensify, decision-making becomes more difficult, volatility increases, liquidity becomes selective, opportunities narrow, and investors who fail to prepare are often forced into reactive behavior. That is how wealth transfers occur. Not because someone predicted the future perfectly, but because some participants understood the structure while others ignored it. I am not talking about fear. I am talking about awareness. There is a significant difference. Fear produces emotional decisions. Awareness produces disciplined decisions. The objective is not to panic. The objective is to recognize the environment accurately. And right now, I believe the environment deserves careful examination because silver's strength may be part of a larger story. A story involving liquidity, a story involving debt, a story involving confidence, and a story involving the movement of capital toward perceived durability. The real question is not whether everyone agrees with that interpretation today. The real question is whether the evidence supporting that interpretation continues growing. Because if capital rotation is indeed accelerating beneath the surface, then the next phase of the cycle could look very different from the one investors have become accustomed to over the last several years. And those differences could matter enormously for anyone attempting to preserve and grow wealth in an increasingly uncertain world. Now, let me take this one step further because this is where the majority of investors begin misunderstanding the situation completely. Most people believe risk is something they can easily identify. They think risk announces itself through collapsing markets, alarming headlines, and obvious instability. But the greatest risks rarely appear that way. The greatest risks develop quietly while confidence remains relatively intact. They develop when investors become convinced that existing conditions will continue indefinitely. They develop when leverage becomes normalized. They develop when dependence on liquidity becomes so widespread that very few people stop to consider what happens if that liquidity becomes constrained. That is the environment I want you to think about carefully because financial systems are not strengthened by excessive dependence. They are weakened by it. And the longer a system relies on debt expansion to sustain growth, the more vulnerable it becomes to changes in financing conditions. History has proven this repeatedly. Every major debt cycle eventually reaches a point where maintaining stability becomes increasingly Difficult. Policymakers face trade-offs, markets face uncertainty, investors face decisions they never expected to make, and capital begins adapting accordingly. This is why I continue returning to the concept of preparation, not prediction. Preparation. Nobody knows the exact timing of future developments. Nobody knows the precise moment when confidence shifts or liquidity conditions deteriorate enough to alter market behavior significantly. But investors do not need perfect foresight to recognize emerging patterns. They simply need the discipline to observe what is happening beneath the surface. That is why silver matters. Not because silver alone determines the future, not because every rally signals a crisis, but because silver can provide insight into how investors are interpreting the broader environment. When capital begins moving toward assets associated with monetary resilience, inflation protection, and financial optionality, serious investors should pay attention because those movements often reflect concerns that extend beyond immediate market conditions. Think about how confidence functions within the financial system. Confidence is extraordinarily powerful. It allows credit to expand, it allows investment to flourish, it allows markets to operate efficiently. But confidence is also fragile. Once enough participants begin questioning assumptions that previously seemed unquestionable, behavior changes, lending standards tighten, risk appetite narrows, capital becomes more selective, and the entire character of the market begins shifting. This process is often invisible at first. Then suddenly it becomes impossible to ignore. The majority never recognizes the transition early because they are focused on outcomes rather than mechanisms. They want certainty, they want simple explanations, they want reassurance. Markets rarely provide those things during important turning points. Instead, markets provide signals. Signals through price behavior, signals through liquidity conditions, signals through capital flows, signals through changing investor preferences. And those signals often appear long before consensus understanding arrives. That is why interpretation matters, because if silver's breakout is connected to a broader capital rotation, then investors should be asking deeper questions. What are institutions preparing for? Why are perceptions of risk changing? Why is durability becoming increasingly attractive? Why is resilience becoming more valuable? These questions may prove far more important than any short-term forecast. You also need to recognize that modern markets move faster than many investors. Appreciate technology accelerates information flow, algorithms amplify trends, positioning adjusts rapidly, liquidity can disappear far more quickly than it did in previous generations. This means structural transitions can unfold with remarkable speed once momentum begins building. Investors who assume they will have unlimited time to react may discover otherwise. That is not pessimism, that is reality. Financial history repeatedly demonstrates that opportunities for preparation often exist long before opportunities for reaction. And those who wait for absolute certainty usually find themselves operating from a position of disadvantage. This is one reason wealth preservation becomes increasingly important during latest stage cycles. When uncertainty rises, flexibility becomes valuable. When volatility increases, resilience becomes valuable. When confidence weakens, optionality becomes valuable. These characteristics rarely attract attention during periods of expansion because expansion creates the illusion that growth alone matters. But cycles change, conditions change, and investor priorities change. The individuals who navigate those changes most effectively are usually not the ones chasing excitement. They are the ones studying structure. They understand that debt cycles create consequences. They understand that liquidity drives behavior. They understand that capital flows reveal information. And they understand that markets often communicate critical messages long before the public recognizes them. This is why I believe silver deserves serious attention right now. Not because of excitement, not because of speculation, not because of emotional enthusiasm, but because its behavior may be reflecting a larger shift in how capital is evaluating the world. A shift toward durability, a shift toward resilience, a shift toward preparation. Whether that shift ultimately accelerates or stabilizes remains to be seen, but the signal itself is worth examining carefully. Because if capital rotation is already underway, then investors who recognize the process early may have a significant advantage over those who remain focused exclusively on short-term narratives. The real lesson is simple. focus on liquidity, focus on structure, focus on capital, flows, focus on incentives, because these forces ultimately shape market outcomes far more than headlines ever will. And if silver is indeed signaling that a broader transition has begun, then understanding that signal may prove far more valuable than simply watching the price itself. This is the moment when serious investors separate observation from emotion. They stop asking what they hope will happen. They start asking what the evidence suggests is happening. And that distinction can make all the difference during periods of significant change. Now, I want to focus on something that almost nobody discusses when analyzing markets. Yet it may be one of the most important forces shaping the current environment. The force I am referring to is confidence. Not confidence in a particular company, not confidence in a particular asset, confidence in the system itself. Every financial system ultimately depends on trust. Trust that obligations will be honored. Trust that currencies will maintain purchasing power. Trust that liquidity will remain available when needed. Trust that policymakers can maintain stability during periods of stress. As long as those assumptions remain intact, markets function relatively smoothly. But once enough participants begin questioning those assumptions, behavior changes, and behavior is what drives markets. This is why I want you to think carefully about what may be happening beneath the surface today. We are operating in an environment where debt levels remain historically elevated. Governments continue spending aggressively, interest expenses continue rising, economic growth remains uneven, inflation pressures have proven more persistent than many expected, and central banks are facing increasingly difficult choices. None of these issues exist independently. They interact, they reinforce one another, they create pressure points throughout the financial system. The majority tends to analyze each problem separately. Serious investors study the connections because it is the connections that create systemic risk. Depth influences liquidity. Liquidity influences asset prices. OSHO prices influence collateral values. Collateral values influence lending capacity. Lending capacity influences economic activity. And economic activity influences confidence. Everything is connected. This is why structural transitions can become so powerful once they begin accelerating. A change in one area eventually spreads into multiple others. And when enough areas experience pressure simultaneously, capital starts seeking protection. That process often begins quietly. Institutional investors rarely announce every adjustment they make. They simply reposition. They reduce exposure where risk appears elevated. They increase exposure where resilience appears attractive. They adapt before the majority notices the change. This is one reason capital rotation can be difficult for many investors to recognize. The headlines usually arrive after positioning has already begun. The explanation arrives after the movement. The narrative arrives after the signal, and by then valuable time has already been lost. This is why silver's behavior deserves attention, because silver often occupies a unique position during periods of uncertainty. It benefits from industrial demand, it benefits from monetary concerns, it benefits from inflation expectations, it benefits from declining confidence in financial stability. Few assets sit at the intersection of so many powerful forces. That does not guarantee future performance. Nothing guarantees future performance, but it does make silver an important asset to watch when assessing broader capital flows. The real question is whether investors are beginning to recognize risks that remain underappreciated by the public. That possibility should not be dismissed. History repeatedly shows that capital often moves before consensus understanding develops. The crowd tends to react. Sophisticated capital tends to anticipate. That difference matters enormously because financial markets reward preparation far more consistently than reaction. Think about every major shift throughout financial history. The individuals who protected wealth successfully were rarely those who waited for universal agreement. They observed changing conditions early. They recognized structural pressures. They adjusted before urgency became obvious. And perhaps most importantly, they understood that cycles eventually change. That principle remains just as relevant today. Many investors have spent years operating in an environment supported by extraordinary liquidity and aggressive intervention. As a result, they have become accustomed to assuming that every challenge will be solved quickly, every downturn will be temporary, every disruption will be manageable, every instability will be contained. But assumptions are not guarantees, and history demonstrates that financial systems eventually encounter limitations. Depth accumulation has limits. Monetary flexibility has limits. Confidence itself has limits. The challenge is that nobody knows exactly when those limits become binding. But markets often begin signaling concern before the consequences become obvious. That is why interpretation matters, and that is why I believe investors should focus less on whether silver rises another 5% or 10%, and focus more on what its behavior may be revealing, because the larger story may involve changing attitudes toward risk, changing attitudes toward liquidity, changing attitudes toward monetary credibility, changing attitudes toward financial durability. These are not short-term developments. These are structural developments. And structural developments often shape investment outcomes for years. I want you to remember something important. The biggest financial mistakes rarely occur because investors lack intelligence. They occur because investors become anchored to old assumptions. They continue viewing the world through a framework that no longer matches reality. They assume yesterday's conditions still apply. They assume previous solutions remain effective. They assume familiar patterns will continue indefinitely. Markets have a way of punishing that kind of complacency. This is why awareness matters. This is why preparation matters. This is why understanding capital rotation matters, because once a transition gains momentum, the window for thoughtful positioning can narrow very quickly. The majority only recognizes change after it becomes obvious, but by then the most important opportunities have usually passed. That is why serious investors focus on signals, and right now silver may be providing one of the most important signals in the market. Not because it guarantees a particular outcome, but because it may be revealing how capital is responding to a world becoming increasingly uncertain. And if that interpretation proves correct, then the next stage of this cycle could unfold much faster than many investors currently